are at Palm Beach. We're at the Distressed Investing Conference, and I have a really distinguished guest, Jack Butler, partner at Skadden, Arps, Slate, Meagher, and Flom. And Jack, you've been involved with so many legendary bankruptcy cases over the years. Let me ask you, though, about what we're seeing right now. We've talked about that last year certainly hasn't been great for the distressed area. 2011 looked like it's going to be more of the same?
Well, what's happening, I think, right now is there's a tremendous amount of capital out in the markets. And so virtually every restructuring is being worked through refinancing as opposed to any kind of a bankruptcy case.
Is that a good thing? Some might say, well, that's great. Companies are able to refinance. That gives them some time to kind of fix some of the problems in their business. Is it a good thing, or is it just kicking the can down the road, which we've also heard today?
Well, actually, what I think is a good thing is for companies to revitalize themselves, to add jobs, to be able to sort through their organizational challenges. Those are all good things. Bankruptcy is simply a technique. If you can do it through a refinancing, if you can do it through an M&A transaction, if you can bring capital in through an IPO, there's all kinds of different techniques that allow you to win.
Right.
And the important thing, frankly, is for there to be job creation, to stabilize businesses, to move them forward in a constructive way. So I'm not really focused on the scorecard of what actually files Chapter 11. I'm more focused on whether corporate America can use what I think is a unique opportunity right now, which is a lot of capital availability at relatively low interest costs to be able to move forward.
It's interesting that you say that, Jack, because we talk kind of ad nauseum about the amount of cash that companies have on their balance sheets, that corporate America hasn't been as healthy as it is today, compared to years past. Having said that, it sounds like to you that you think that there are a lot of companies out there that aren't doing it and should be doing it, accessing more capital, dealing with some of their debt.
Well, if you look at, a couple of years ago, everyone was talking about this massive wall of debt that was going to be here that couldn't be refinanced. And lo and behold, almost half the wall of debt has been refinanced. But there's still, at least a third of that wall of debt, the original wall of debt, that hasn't been refinanced. And
right.
You have to sort of say to yourself, why is that? Well, those companies are the ones that are having more challenges, even in these capital markets. And I think it is important for people to take the advantage that they can of the markets.
If they're not taking the advantage now, I'm just thinking hypothetically, eventually we're going to see interest rates move higher. We're going to see the Fed stop doing their QE programs. You're going to stop seeing all of these stimulus programs coming out of Washington. If they don't take advantage now, does that maybe in 2 years from now, 3 years, set up for a tough spot for a lot of corporate America?
Well, one of the questions I think everyone has right now is whether or not there's another bubble being created by the kind of liquidity that we're seeing. I think there's a number of people, I can count myself among them, who think that we're seeing more of a liquidity recovery right now than a fundamentals recovery.
Is it that, though? It certainly feels that way.
I think if we all knew the answer to that, we'd be taking, we're opportunistic in this country, we'd be taking advantage of that, right? I don't think we all have all of the answers, but I really do believe that this is not really a fundamentals recovery, and as liquidity goes through a cycle, and it will, interest rates will go up. There will be more challenges down the line. Then the companies that haven't prepared themselves for that, who haven't had liquidity and fixing their operations uppermost on their calendar, those folks will have difficulties.
You've got a book out. It's called Navigating Today's Environment, and you talk about how directors and officers need to be, well prepared to meet the demands of today's post-recession environment. What are these demands at this point? Are they different from what they were a few years ago? Have they really changed significantly?
I think they've changed in the respect that I think that officers and directors, in addition to fulfilling the responsibilities that the law requires them to, which is to be fiduciaries, beyond that, I think officers and directors also want to try to have the best practices they can have. And that means, for many of them, going beyond what's simply required of them.
Right.
And that part of it causes them to want to have best practices programs and to evaluate risks ahead of time and to put processes in place so they can identify.
So we don't have too big to fail?
Right, so they can,
No, seriously.
Right. The reality is you're always going to have some corporations, some entities that will be almost too big to fail, that will cause systemic risk in the country. And that's a political question as well as a legal question.
I got 20 seconds left here. We talked about the muni market a lot in our last segment. What do you think? What's your assessment? You write about the muni market also in your book. What's your assessment of the muni market right now?
In 10 seconds, I think the muni market is going to have less bond defaults than people are predicting, a lot of restructurings, most of them outside of bankruptcy court in a political process.
All right, but manageable.
I think they'll be manageable, but more challenging than they have been.
All right, guys. Jack, thank you so much.